Good morning, everybody. Today we have two sessions. The first session will be handled by the CA Manoj Shah on current and capital account transactions, liberalized remittance scheme, and disclosure of foreign assets in income tax return. And the second session will be done by our own past convener, CA Seema Mehta on soft tax certification for non-strip units applicable to software service exporters and foreign liabilities and assets in the annual return. Before we start the first session, I request all of you to rise for institute motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता
It's raised for national anthem.
जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
Thank you. Please be seated. I'll just formally introduce CA Manoj Shah. Manoj Shah is qualified chartered accountant in the year 1987 and is a founder partner of the firm Shah and Modi Chartered Accountants. His focus areas of practice are exchange control regulations, that is FEMA, international taxation and transfer pricing. He is the past president of the Chamber of Tax Consultants and past president of CVOCA Association. Presently, he is a member of editorial board of the monthly journal of the Chamber. He contributes to FEMA updates column of newsletter published by WRC and to the journal published by ICAI. His contribution to publications which includes International Taxation, Compendant 4th edition published by the Chamber of Tax Consultants, FEMA in reference of WRC, reference on FEMA, a publication of ICAI, co-author of publication Tax Withholding from Payments to Non-Residents published by the Chamber, co-technical reviewer of the publication titled FEMA Compounding Orders, a comprehensive analysis. He has delivered talks on FEMA and non-resident taxation at various seminars, conferences across India. I now request our past convener, CA Seema Mehta, to present a memento. Now I welcome CA Manoj Shah. Please come. Again, first ones.
Good morning. So thanks, Seemaji, and for inviting me to this JB Nagar study circle and all the organizers of the study circle. So before we move on to the subject, what I'm trying to do while the subject is capital and current account transaction, but the related next topic, which is about LRS and the disclosure of foreign assets, we'll also touch upon certain aspects of residential status under FAMA, because that has got linked to so far as person returning Indians are concerned, how their assets are to be disclosed and other aspects. So we'll slightly, it will be more of a basic initial part. Wherever possible, I'll touch upon the issues also. And based on the organizers, do we want to have interactive, or at the end, whatever, I'm open to either of it, the interactive session. So now we move on to the presentation. And so what is the relevance of PAMA? Because once we really get into the basics, the most of the issues related to PAMA will be much more clear. Sometimes, while issuing or addressing particular problem, we lose sight of what is the basis of PAMA. So it is an act to consolidate the foreign exchange. Basically, the preamble says that it is an act to facilitate external trade and payment, and it channelizes the foreign exchange. When you say it channelizes the foreign exchange, means that today also, after almost 30 years of liberalization, or more than 30 years, if you say 92 as a year when we had new industrial policy, still there are certain areas where central government or Reserve Bank doesn't want foreign exchange to flow in particular direction. For example, today also, if you see the real estate market, no foreign nationals are allowed to buy and sell properties. So trading in real estate is still prohibited. Why? Because we don't want foreign money to come to this kind of activity, which can lead to hot money, speculative activity in real estate. While we have allowed FPIs or foreign institutional investors to make investment into equity and portfolio related category, but we still are not allowing any foreign national, I'm using the word foreign national, or even corporates or foreign entities to buy and sell real estate. So this is how we channelize. So we restrict. Okay. This is the structure of FEMA. You have slightly complicated, and that's why probably, even after so much, understanding of FEMA, it becomes very difficult because you have to run through different, text under FEMA. So you have got Act, which has got 49 sections. You have got section 37A, which is as specifically mentioned here, which says that it is now under FEMA also they have got power to seize assets in India. If you are holding certain assets outside India, which is in contravention of FEMA, FEMA gives power to seize certain assets in India. And RBI is entrusted with administration and implementation of FEMA. Of late, the power to define capital account transaction is now with central government. And therefore, this administrative powers are with the Reserve Bank. So far as transaction connected to debts are concerned, okay, borrowings or external commercial borrowing, this is within the policy framework of Reserve Bank of India. But when it comes to capital account transaction, what sort of foreign investment should be allowed into certain sectoral things, like defense should be go to 49 or 74, or want to open insurance sector fully to non-resident or foreign investments. These are the policy decisions related to capital account transaction, which will still, now it has been shifted powers from Reserve Bank to central government. Central government, while in consultation with Central RBI may formulate policy, but the power, the regulatory authority now remains with the policy framework remains with central government. So this is the structure of FEMA. You have got act, you have got notification, you have got rules, you have got master direction, then you have got authorized persons directions and FAQs. So basically, you know, what is happening under FEMA? While FEMA has got only 49 sections, FEMA has got only 49 sections, and there is hardly any amendments in last 30 and 99 if you count in whatever 23, 24 years. But if you look at the notifications, you know, there have been quite a many notifications. Even the APDS circulars are quite frequent as compared to income tax, where, you know, probably you will have very lesser number of circulars. And then you have rules and you have master directions and circulars. This is the structure of FEMA. So unlike income tax act, why I'm trying to draw analogy with income tax, it will make easier for you to understand and grasp FEMA, how it is structured. And when you're getting into the problem or you want to get into FEMA, how will you look at how will you address a particular thing? So you've got act, then you got notification. Say, for example, under income tax, you have got chapter on TDS, you got chapter on capital gain, you got chapter on income from house property. This is in the one piece of legislation, you've got everything covered in section 1 to 292 or whatever. Here is an act which has got only 49 sections, but then there are different notifications. So every capital account transaction will have now rules. Earlier there were notifications. If it is a debt related, this will be notification, how much you will realize, what way you will realize foreign exchange, how you will repatriate. So there are notifications, and each notification is a kind of self piece of legislation. So that is how you have got act, you have got notification. Then comes rules, which I mentioned. The rules are framed by central government, mainly dealing with non-debt instrument about overseas investment and inbound investment. And master directions. So master directions are nothing but summary of authorized persons directions, which are issued by Reserve Bank of India. What happens is that FEMA is a very, very dynamic law, you know, because whatever changes take place in the global economy, FEMA will have to keep pace with those changes. You know, you cannot have annual event like income tax where you have only finance bill coming on 1st February, you know, which is the way you set out policy, you make the amendments. Here is a piece of legislation which has to got economic impact also. And therefore, depending upon the circumstances, RBI will come out with amendments, which is through authorized person directions, which is nothing but circular. So they call it directions. And these directions, since the changes happen globally, you'll have to keep immediately coming out with circulars. For example, recently we got the circular last year to say that, you know, under liberalized remittance scheme, though you're allowed to make remittances, but if you are not able to utilize the remittance which you made overseas, you will bring back funds back to India within 180 days. Why this was introduced? Because we saw that, you know, there's a continuous depreciation of rupee. Globally, they realized that, you know, probably people are parking overseas money, but they are not trying to park it. I mean, not able to channelize it for productive purposes. And these are the changes which happens. There was exceptional time was, you know, in 2007 and 8 when rupee started appreciating. So this was the time, say, for example, before Lehman crisis. When 2007 dollar was quoting at around 45, within a span of 30 days or so, it came to 39. Now, when it came to 39, RBI came out with circular saying that, you know, if you are raising external commercial borrowing, you will not bring back those money back to India. You keep it there and there only, unless there is a need to spend. So they were trying to curtail inflow of foreign exchange because rupee was already appreciating. Now, one will say that, you know, what it is good for a country as India if rupee is appreciating. But sudden fluctuation is not good in the sense that nobody had expected at that point of time that rupee will appreciate. So if I am an exporter and I am contracting for an export, assuming the dollar is 45, and I have my calculation, and considering other export incentives and other things, you know, I am okay with 45. Suddenly, when I enter into a contract, I start production or manufacturing, and I realize that it is already 39. Literally, I will be supplying at loss. So these are the changes, you know, in economy where RBI will have to intervene. They intervene through secondary markets, sometimes through these kind of amendments, and therefore APDS circulars are a bit frequent. Of course, of late, it has the frequencies also come down. But the point which I'm trying to drive is that it's a very, very dynamic law. It has to deal with global economy, keep pace with those changes, and therefore you have got APDS circulars to channelize foreign exchange again, sometimes if even policy making decisions are introduced through these circulars. And then you have FAQs. Of course, FAQs are off late on since the power of capital account transition now is with central government. Those FAQs are quite old now, so far as FDI or ODI is concerned, but still they can be a guiding force, but not a binding thing. So this is the summary of section 1 to 49, how it is structured. So you have got application, as usual, you have got section 2, which deals with definitions. 3 to 9 section are substantive sections, which deals with, relating to regulation and management of foreign exchange. Then you have got provisions relating to authorized persons. I'll touch upon this aspect. Then you have other procedural part. Master direction, as I told you, this is a summary, and master directions are updated as and when the APDS circular is introduced. So if you are looking at any master direction, if you go to RBI side, you will get, and they will say that it has been updated since say April, January 24 or Feb 25, whatever, January 25. So that is where every amendment through APDS circular gets summarized into master direction, and now it is kind of online. I mean, it is real-time basis. So therefore, the master edition, otherwise, whatever is there, you will get an updated version. APDR circulars are again binding not only on authorized persons, but even on the person undertaking FEMA transactions. Unlike income tax, where circulars, you can say it is binding only on tax department. No. Here is a circular which is in the form of directions, and if any contravention of even circulars will result into contravention of FEMA. And this has been upheld in case which I have quoted here. So basically the sanctity of APDR circulars. Then there are certain definitions, which is very key to understanding FEMA. So you've got foreign currency. What do you mean by foreign currency? It says any currency other than Indian currency. Then you've got foreign exchange. So foreign exchange and foreign currency are definitely different terms. You have got exchange, which could include checks or deposits or credit balance payable in foreign currency. So foreign exchange per se is also defined. Then there's a definition called repatriate to India. What do you mean by repatriate to India? I'll touch upon this aspect, but for the time being, the definition says that foreign repatriate to India means bringing into India the realized foreign exchange and selling such foreign exchange to an authorized person in India in exchange for rupees, or holding the realized amount in an account with authorized person in India to the extent notified by Reserve Bank. So the second part, the holding of realized foreign exchange in an account, is something like EFC account, exchange earners foreign exchange. The RBI allows you to park certain money in EFCs provided. Otherwise, it is your obligation to realize and repatriate. So when you say realize, you are taking control of foreign exchange, and repatriate means you are bringing it to India. Now comes the heart of it. This is where probably let's look at the foreign exchange. So who owns foreign exchange? As an exporter, say for example, you have exported goods and you are realizing foreign exchange. So what happens to foreign exchange that you are earning? So for person resident in India, mind well, for person resident in India, it's the central government who owns foreign exchange till the time we achieve full capital account convertibility. Yeah. So you have to bear in mind that foreign exchange doesn't belong to me. Even though I have earned it, it doesn't belong to me. Moment I earn foreign exchange, it is my obligation to realize. That is, I take control of foreign exchange. I put all my efforts to realize. Then I have to repatriate back to India and sell it to authorized person, who are again within the purview of Reserve Bank. Reserve Bank, in turn, being a central government agency. That's what I say that it belongs. Foreign exchange belongs to central government. So if you're trying to look at income tax, I'm trying to draw this analogy to say that, if I'm person resident in India, my global income is taxable, right? Because wherever accruing or arising, wherever. Now, similarly, when you say I'm person resident in India, and when it comes to FEMA, they say that, moment foreign exchange is accrued, instead of accrual, they use the word due. When it is due to you, it is your obligation to realize and repatriate. It is a fundamental thing of FEMA. And moment I realize and repatriate, I cannot hold it. As I mentioned, only up to EFC account or something. Otherwise, it is my obligation to surrender it. Surrender it means what? You will get Indian rupees in exchange, right? So bank, say for example, wherever you got a bank account, bank will buy the foreign exchange, will give you Indian rupees. Now, bank has earned foreign exchange. It is not bank, but it is the Reserve Bank. Now, what does Reserve Bank do with foreign exchange? That's where probably you will see the recent phenomena that now China yesterday has said that we are not going to buy US Treasury bonds. India is also a big buyer of treasury bonds. So foreign exchange, today's world is fully, determined by economic power. And that's why US is trying to always enforce upon the world. How are they ruling? Because of this foreign exchange. They said that, entire world trade should happen in dollars. Saddam Hussein did revolt, say that I don't want to sell my oil in exchange of dollar. And he was killed. Right, whatever we say. I mean, let's not go to the political aspect. But the point which trying to say that the foreign exchange has become such a crucial thing in today's economy that the traditional or conventional war has got no relevance. It is how you are trying to control the world through your power. If US economy has got huge debt as on date, I mean, if you look at the kind of voluminous debt they have got, economy may not be doing good, but the power to rule the world is through foreign exchange. How are you going to control the world trade? And that's where probably when India now trying to say that we are trying to deal in rupee, we have got an arrangement to say that around with 18 or 20 countries, we will have rupee trade. And the opportunity which got out of COVID and out of Russia-Ukraine war is enormous. India has really capitalized that. Thanks to the government, the bold steps which they have taken, we are able to buy oil in rupee. And therefore, Russia has got trade surplus with India. I mean, they are holding rupees. And this is how we are trying to now say that with Indonesia, Malaysia, Sri Lanka, and many other countries, we are now trying to deal in rupee. But as the things go and as politically, what we are seeing, again with Trump coming in, they already said that, we want MAGA, MHGA to say that, if those who trying to not accept dollar as a currency for trade, we will not spare them. So this is a kind of stern warning which has come. Let's see how the things pan. But the point which I'm trying to drive is that this is the importance of foreign exchange. And every country, every developing economy, will have those challenges. And therefore, if you are not trying to realize and repatriate foreign exchange, you are creating a problem. The whole laws dealing with foreign exchange in terms of PMLA also got this aspect now, Economic Fugitive Act, all these are offshoots of this. If you're trying not to earn foreign exchange, things are going to be bad. So things have changed from 2014 onwards. And I'll touch upon when we look at the disclosure of foreign assets part, how this black money and especially foreign assets undisclosed have got quite severe impact. Repatriate to India, we have already seen that. A manner of repatriation, we have already seen that. So now, just trying to give you flavor of how and why it is important to realize foreign exchange. These are the cases which is happening many times. You would have also come across that. This is the case where there is a real life case where an architect had rendered some consultancy services to a UAE based real estate developer firm. And he earned architecture fees, consulting fees, and instead of bringing it back to India, he invested directly in the property overseas. Okay, now here comes a contradiction. So your obligation was to realize and you being resident in India, your obligation is to realize and repatriate foreign exchange. And if you wish to buy property, you sell first foreign exchange to realize, convert it to rupee, then buy a foreign exchange under liberalized remittance scheme in your individual capacity, and then remit within the limit of $250,000. This is where the transaction should happen. You can't take a plea that my property which I've acquired is less than $250,000, and therefore I'm allowed to set it off. No. Your obligation is to realize and repatriate. Moment foreign exchange is accrued or due to you, it is your obligation. You cannot escape that. Yeah. So EFC, if you got EFC, you park it in EFC. But EFC is a trade account, it's a current account transaction. You will have to, realize, surrender it because, okay, and then again buy. So see why this is important is because Reserve Bank wants to, or any, for that matter, any government, any nation or state, every penny of foreign exchange is monitored. You will be surprised. Every penny of foreign exchange. Today, if I buy a foreign exchange to say that I want to remit money for child's education, they ask me to file Form A2, right? I submit that, and that gets captured, that this money is gone there. for so and so. If there's a realization of foreign exchange, you say that there's an export of goods, there's an export of goods. If you remit money for investment in unlisted entity, it gets captured. And every data is captured on basis of at the central government level or RBI level in on terms of capital account transaction and current account transaction. What is the nature of remittance? Has it gone towards capital? Has it gone towards capital? Has it inward is upon capital or on current? If and therefore there is a strict regime on external commercial borrowing under FEMA as on date also there's a very strict regime on how much you are borrowing. Because today, if you are saying India is sitting on say 600 billions of foreign exchange reserves, maybe we have lost some bit of it in recent times due to FPI pulling money back. But point is, out of this 600 billion, what is the composition of debt? Moment I say that today, all these big corporates, which there is overseas funding, if there's a component of debt within this reserves is more than 28 or 30% is an alarming situation for any country. And therefore, there's a strict monitoring. And hence all the reporting under FAM. That when I receive foreign exchange for, say, for example, I've received as a foreign direct investment, there's an unlisted company in India which is receiving share investment, equity investment from non-resident. I'll file that FCGPR, I'll report that because that is how I intimate that this money has come by way of foreign direct investment. Government prefers foreign direct investment because it is a long-term money in India. It is a non-debt. Money is not likely to be taken back immediately. If it is taken back, of course, there will be capital gain in the hands of non-resident and money will, foreign exchange will outflow. But generally, FDI is most preferred because it is a long-term money. Unlike debt, which will have certain tenure. And therefore, today also under external commercial bond, BCB guidelines, you will find that only long-term debts are permitted. And that too for productive purposes. Unless you are manufacturing concern, you can have 1 year minimum average maturity period. But for other working capital, it is 5 years. If you are borrowing from certain with non-shareholder or other person, it is 10 years limit. So why this 3 years, 5 years, and 10 years limit? Because whatever are the shocks, like I said, 2007-8, or suddenly dollar starts depreciating or foreign exchange is depleted, resources are depleted, it will not put pressure on central government. Because once I say that central government is the owner of foreign exchange, it is their commitment, central government's commitment to give foreign exchange to its resident or to its entities based in India. India is also signatory to WTO, World Trade Organization, under which we have said that India is fully open on current account. If there's a transaction in foreign exchange on current account, we are committed to say that we will allow our residents to buy foreign exchange as and when required. If you look at Narayan Murthy in 80s when he wanted to import first computer, those two big desktop, he said that it took me 3 months to buy foreign exchange. So those were the days, which we have gone long ahead after 92. Today on swipe of card, you and me just, swipe foreign exchange and buy foreign exchange. Those are the days, where we were before 91 and now the situation is. But the point is that ECB or foreign currency borrowing is also quite strictly monitored, and hence what point which I'm trying to drive is the relevance of foreign exchange. You have to realize, you have to repatriate, and then do. Otherwise, it will be treated as a very serious contravention. And moment the contravention is 1 crore and above, ED will enter. And ED will entering, then you have got complications under FEMA. In addition to, they you have severe, this will be malafide intention proved kind of transaction, which can lead to 3 times the penalty. So in this case, also architects, for example, property is unearthed and this understand is there. It is 3 times the penalty, in addition to your tax consequences, which is different. Okay. This another point on foreign exchange and relevance of foreign exchange and how documentation is necessary, what kind of care you should take is about, this is a real life case. This is a company in India which was into sugar manufacturing, and it went to a trade fair, which was a machinery fair in Germany. And they were looking for some machines, and therefore when they finalized a vendor, and the vendor had a scheme that if you buy one machine, it's fine, but if you buy second machine also or place order for second machine, I'll offer 25% discount on first machine. So if 100 is the cost, you will get it at 75. This condition attached to this scheme was that you will have to pay 15% advance for second machine. So in short, I am paying 90, right? But I'm getting overall benefit of 10. Now, this is a company which imported first machine and gave import advance for 15%. This advance was to be utilized within a period of 2 years, and instead of importing machine, they realized that that better makes are available, or the machine price have gone down, and you're also getting China make machinery, and therefore they delayed the acquisition. Meantime, this amount remained outstanding. So as I mentioned, every penny is captured in the database, and therefore this import advance remained outstanding. The authorized dealer or banker did send mail to the company saying that this amount is outstanding. Due to change in the organization, because the staff had changed and their email system had changed, and therefore they couldn't respond to that notice. Matter was referred to ED. That you have sent money for import and you have not utilized it. And this is how. So they had to explain that this was basically an India favoring transaction. This is the scheme where we still save 10% of foreign exchange, which otherwise they would have remitted, but nothing doing. Matter once it goes to ED, it has got its own implication, and it was not compounded. It was compounded by enforcement directorate. What I mean to say is, but this could be a severe consequences. So even though technically transaction is genuine, your intentions are quite okay, but if you are not able to realize, repatriate, and use foreign exchange, the purpose for which you are drawn is also a contradiction. Now we touch upon bit of residential aspects, because this will then give idea about what do you mean by, because obligation is upon person resident in India to realize and repatriate. If I'm not a person resident in India under foreign exchange, then there's no obligation. And therefore it is relevant to understand the nuances of what you mean by resident under FEMA. They use the term person resident in India, PRII. Okay. So you got two types of residential status, person resident in India and person resident outside India. Under FERA, it laid emphasis on citizenship. Are you citizens of India or not? So even if you are in India, but if you're not citizen, there were different parameters. But under FEMA, it says if you are residing in India with certain objectives and certain purposes, you will become resident, even though you are not citizen of India. Okay. The definition of resident is silent about students going abroad, and we'll touch upon this aspect in bit detail. So definition is given in, this is the definition in 2V1 of FEMA. But I'm trying to say that, FEMA, when it comes to FEMA, you will lay more emphasis on intention. Intention of person coming to India or intention of person living in India. And what is the intention of living in India? If that is proved, then you are non-resident under FEMA, okay, rather than being resident. So in the previous financial year, it says that if you are in preceding financial year, if you are in India for more than 182 days, okay. So instead of looking at the relevant financial year, I look at the preceding financial year and then try to see whether I'm resident or non-resident. It says that you left India. I mean, where you are resident in India for more than 182 days, yes, but have you gone India out of India for any of the reasons? Now, reasons are three reasons. So even though I was resident in preceding financial year for more than 182 days, but if I'm leaving for these three purposes, what are the purposes? Taking up employment outside India, or carrying on business or vocation outside India, or any other purpose for which my stay is uncertain. If these three situations are there, and if I left India, I'll become non-resident from day one. I don't have to look at even current financial year number of days. For example, we are into January 12th. A person has left on 1st January for the purpose of employment. Okay. He is left for the purpose of employment. When I say employment, you are living for job overseas. You are being employed by overseas. It is not for any exploratory tour. You are not being employee of Indian company. You are not going to develop overseas business. Okay. You are living for employment. And how will you determine you are living for employment? In addition to the employment letter and other things, you will always examine visa. What kind of visa this person is going with. Okay. Having said that, I left for employment, from day one I become non-resident under FEMA. So even though my current year stay is from April to December, which is almost 270 days, in the preceding financial year also I was for more than 100 days, but since I left for employment, I become non-resident from day one. Now, why this kind of situation which is different from income tax? Let's go practical. On 31st January, he receives a foreign exchange in the form of salary. He earns salary, right? Now, if you make him resident, he will have to repatriate. So even though he's staying there, he has, and if you make him resident for this financial year, he will have to repatriate foreign because Section 8 says it is mandatory. So therefore, you will not look at, you are examining residential status on the day when there is a transaction of foreign exchange. You can't wait till 31st March. So I left for employment, I become non-resident on day one, and then I'll be allowed to park my salary overseas. From that salary, I can remit money to India, have my NRE account, have my PIS account, whatever I want. Right? So this is the relevance. When it's second point is when I leave for business or employment. The point is when I leave for business or employment, again, as I mentioned, there could be a situation where a person is outside India. Say, for example, a travel agent who is conducting, this pleasure trips. He may be outside India for 270 days, but he may not be, that may not be non-resident under FEMA. He may say that I am outside India for more than 102 days under income tax to say that I am non-resident because he has not left for business or occasion. His business is in India. Meanwhile, so that's why I say, how will you determine status? You'll have to look at under FEMA and the visa. If he has left India as a PR visa, permanent residency visa, or some other visa, some investment-based visa, and he's trying to shift his base from India to a particular country, for example, Portugal. It was in hot demand few months back, Portugal, because they were coming out with some investment-based scheme, and you would get Portugal residency, and then because of Portugal residency, you will not be allowed to get. I mean, you were free to enter into any European Union countries, right? So Portugal was in great demand. So if you're trying to shift your base, then you are living for business or employment. So you will have a look at visa. It is not, as I mentioned, if I'm merely on a business visa, and even though I'm outside India for more than 180 days, it will not lead to non-resident under FAM. And any other purpose. Now, any other purpose is they have kept it, bit vague, but rightly so, because every facts and circumstances will decide, whether you are in India or outside India. There have been cases where people have come to India, the reverse case, and for medical or health treatment. Say, for example, Kerala is known for, alternate medicine or Ayurveda-based medicines, and people have come to India for curing cancer or certain, chronic diseases, and then they extend their stay. They keep on extending their stay. A situation comes when they get their families back, their children are here, their family is here, and then they are still on tourist visa. But these are the circumstances which will decide that now you are trying to be in India. You will be regarded as a resident under India. So this is any other purposes, this is the way. So any issues on residence, because this is quite crucial. Okay. Yeah. Now come to student. Yeah, this is why I'm emphasizing on intentions. When I say intention, look at this part. Under FEMA itself, they say that if a person is returning to India, okay, and it says that NRE account should be redesignated as resident account, or funds held may be transferred to RFC account immediately upon return to India. So if a person is returning from Canada, say, right, and these are the days where probably Canada is losing its shine and many people are returning back from Canada. Now they return to India for good, and they say that I want to be in India. Then I will not examine, whether in current year or preceding financial, I was there for 182 days or more. I'm coming on, say, December, I came back to India. Naturally, for last, that is April 23 to March 24, I was not in India for 182 days or more. Therefore, if you go strictly by definition, I'll still not qualify to be resident in India. But they say that, what is more important is intention. If your intention is to come back to India, you are not on a visit. You are coming back to India, then you will immediately convert your NRE account to RFC, or you convert it to NR or to normal saving account. This is where it says that, intention matters. So the relevance of, what is the relevance of 182 days or more, which we saw in the definition that, there is the relevance of 182 days or more in preceding financial year is only to the extent that if you are a foreign national, mind well, I'm using the word foreign national. If you're looking at FEMA, try to divide the foreigners or foreign entity into 4 categories. One is easy NRI, that is, he has moved out of India, but he continues to be Indian citizen. is NRI. Other category is overseas citizen of India. He has moved out of India. He has surrendered Indian passport. He has now taken foreign passport. He is OCI. You got foreign entity, that is any limited LLC or LLP or INC. And then you got foreign national. He is not NRI, not OCI. So divide this non-resident into 4 category and then try to apply. So here is a case where foreign national is in India. So PIO is a concept which is akin to OCI, but now for certain investments, OCI status is mandatory. So for example, you want to invest in immovable property in India as a non-resident and you are not holding Indian passport, you must own OCI card. You must have OCI card. Okay. So PIO will only allow you to have NRE, NRO account. You cannot have investment in equity shares or portfolio and other aspects.
So OCI doesn't require Indian visa to travel, right?
Yeah. OCI will not require. But still there is some resistance with a lot of people. They don't want, to be in the radar of Indian government. They say we don't want OCI card.
Right.
But there are challenges, when it comes to inheritance. So when because they have got absolutely no connection with India, but their parents are in India, they've got a lot of property. So when you want to inherit, probably there could be some challenge.
Non-resident, can they have other?
If you are citizen of India, you can. You are a citizen of India. If you continue to be a citizen, you can. But otherwise, there's no need for income tax. Also, there's no need to have.
Not mandatory.
It's not mandatory.
For foreign citizen and still holding other.
So you would have when you were resident of India, you have got this Aadhaar card. So you maybe continue with that. So yeah. So the purpose of 180 days in preceding financial year is specifically for foreign nationals who say that now we are resident of India. There could be a situation where there are foreign nationals who have got no OCI, no NRI, they are not second generation of those OCIs. They are purely foreign nationals. And they are settling in India. And if they wish to buy immovable property, then the FEMA doesn't now restrict to say that, even if you're a foreign national, you cannot buy immovable property. You can buy immovable property in India if you're a resident of India, provided you are not citizen of those 11 countries, which includes Iran and, Pakistan, Bangladesh, Macau, and there are a list of 11 countries. Iraq is not part of that restricted list. But point which I'm trying to say, if you're a foreign national, citizen of countries, say, for example, US or UK, but if you're a resident in India, you will be allowed to buy immovable property in India. Yeah.
Definition of non-resident or resident, I mean, there are other condition also last preceding financial year. Must have stayed for more than 16, right?
That is under income tax.
So even I think FEMA to end or to own.
No. There's a concept called person resident but not permanent resident in India. If you are a foreign, if you are in India for the purpose of employment and your employment is of a specified duration. So instead of R but NOR, you have also got a concept of resident but not permanently resident in India. The advantage with such kind of person is that, you can repatriate your entire salary income net of taxes or other income. So that is resident but not permanent resident in India. It is not coming out of definition. It is mentioned in current account rules. And that's why it becomes very peculiar under FEMA because everything is not, systematically captured. And it becomes very difficult at times. You look at ad, you look at notifications, certain things comes from rules, and you have got RBI direction, which is again more explaining and sometimes expanding the scope of what is given under rules. So that is where probably the challenge is. Now I'll spend 2-3 minutes on students. So this is a crucial aspect because student, if you see, he is not living for employment. He is not living for a business. And even you can't say that he has left India for the purpose or circumstances which would say I am for indefinite period, because my visa would say that, I am there for 2 years, 3 years. So my period is definite. Now, if you're not living for employment, if you're not living for business, therefore, what is the status under income tax? So you will say that based on physical state, but under FEMA, there's no clarity. Definition is silent. They came out with circular, which is quite old of 2003, but the circular still holds good. And they say that, students, they know that students are allowed to work based on university rules or wherever you are studying, they permit you to work for certain hours in a week and you will be earning some remuneration out of that, stipend or other things. And so circular says that, if you wish, you can call yourself non-resident. So the last line, if you see, Hence, their stay will be for more than 180 days, and intention will also be to stay outside India for uncertain period. Thus, they can be treated as non-resident. Circular says that it can be, not shall be or not maybe. You, if you wish to, in my view, if you're examining the residential status of a student, the choice remains with student himself whether to call him a non-resident under FEMA or not. FEMA's intention is to treat him as a resident. Primarily, FEMA says that if you are a student under FEMA, you will be resident of India. And why so? Because there are two references which I have given. One is Regulation 5F6 of FEMA Notification 10R. It says that a person resident in India who has gone abroad for studies. They use the term a person resident in India who has gone abroad for studies. So you are outside India, but you are resident of India. And maintain foreign currency account with bank outside India, because you are earning, likely to earn, or maybe for your livelihood, you will have to bank account over there. Those can be kept, bank account can be there. On the return to India after completion of studies, such an account will be deemed to have been opened under LRS. Right. And another is borrowing. So notification 3R deals with external commercial borrowing, which says that, which is an individual resident in India studying abroad may raise loan in foreign currency not exceeding 250,000. So primarily FEMA says that it is likely to be resident, but if you feel that, I want to, because they say can be. So if you want that, my intention is after 1 year or 1.5 years of study, I say that I'm likely to get job, even though I am in a probation period, but my intention is to stay abroad. And then I'll immediately call myself to be non-resident. And how will you disclose this non-residential status under FEMA? The only way is that, you convert your bank account to NRO account. This is the only way. I mean, you may write to AD that I have become non-resident, but the Reserve Bank, there's no reporting, there's no some kind of intimation to be given. So the best way to communicate your intention that I have become non-resident is to convert your bank account to an NRO. Yeah.
Person studying abroad, student is studying abroad outside, and if there is balance of 500,000 USD, so how does it impact? Once you take 250,000 will be considered as a
So if you have remitted SSA account is to be deemed under LRS. Now, if you are not utilizing now under the recent direction of after August 22, if you are not able to utilize this 500,000 within 180 days, you will have to repatriate back to India. So if you are returning Indian, you will be allowed to hold your all the assets overseas. There's no compulsion to realize and repatriate foreign exchange arising out of those assets which you have created while you were non-resident. You have earned, you have created asset overseas. Unlike FERA, which mandated upon return to India, there was time limit of 7 years, within which you will wind up everything, realize and repatriate foreign exchange. Having now, stable condition on foreign exchange, we are sitting comfortably, and this is the kind of facility given to say, if you're returning Indian, you continue to own all your foreign assets. Okay, so that is section 6.4 of FEMA. The 6.4 will not mandate you to realize and repatriate also. So if I got investment in say Microsoft and if I earn dividend on that, if I have to return to India, I become resident under FEMA, but as section 8 will not apply to me. Why? Because 6.4. This is the asset which I created while I was non-resident, and therefore dividend I will not bring back to realize or repatriate. So it becomes 6.4 class of persons. So asset is not 6.4, but person is 6.4. So if I'm returning Indian, having created asset overseas, I'll be allowed. So if I've inherited also asset from non-resident, while was non-resident in India, this 6.4 will apply. So the limited point is that 6.4 things can be continued to be kept overseas. Of course, you will disclose everything once you become resident and ordinary return. You will have all the disclosure in foreign assets in your income tax return. But you can continue to keep those assets overseas without realization, repatriation, or income to be brought into India. This is APDS Circular 90. I'll not go into details for paucity of time in terms of what can be done, what are the transitions which are allowed. But point is, I have a details verbatim copy of circular to say that what I'm allowed. So interesting part is, when I say that such person is back to India, for example, during COVID period, I came back to India, okay, from US, and I continue to work from home now. Okay. If my intention is to move back to India, as I mentioned, I am not resident under FEMA. If my intention is to move back, even though I'm in India for 2 years, but if I say that because of the compulsion of COVID or some other reason of my ill health of my parents or whatever reason, I say that, I want to be in India, I want to move away. I'll not convert anything to my NRE, NRO will continue, everything will continue. The interesting part is, the question arises, am I supposed to realize and repatriate foreign exchange back to India, which I'm earning through salary? If I'm non-resident by intention, I'll not repatriate. But even if I'm in India, for good, if my employment continues where I was, probably it says that, I will be allowed to keep my salary overseas. Because the second bullet says that income earned through employment or business or vocation outside India taken up or commenced while such person was resident outside India. Okay. So in my view, you'll be allowed to continue to keep your salary income overseas, okay, in such cases.
Will be the impact on taxation.
You'll have to pay on global income. You'll have to pay global income. There's no choice.
TDS will be deducted there also, and here I will offer it for him.
You will offer for can claim credit. Actually, on salary, there is a controversy. In my view, generally, every country deducts salary. If you say, for example, you are working from India and you're never for US employer, you have been working from India, right? Now, if you look at treaty also, okay, if you look at treaty also, it allows salary to be fully taxable in India. There's no right to US to tax this salary. Because if you look at the source rule for taxation for salary is different from fees for technical services, professional services, royalties or dividend. There the concept is not of payer and pay. If I'm making payment of technical fees to non-resident, what is the source rule for taxation in India? That if the resident is paying to non-resident, obligation is there to deduct tax. But if resident is paying salary to non-resident, you see it is not applicable. We don't deduct tax. If somebody is working, Infosys has got branch in say US and they pay salary to branch employees over there. Even though you are claiming deduction in India for salary, you don't deduct tax under 192, right? Similarly, if I'm working from India for US employer, actually US has got no right to tax, but nobody bothers, and we try to, yeah, you can keep it here. So, they deduct the tax and we claim the credit and credit is allowed also, but this is wrong. Today, Indian tax authorities can say that I will not allow you credit because the US has wrongly deducted the tax and you pay full tax and claim refund there. It's quite possible. And in my view, this is the right approach. This is the right approach. Because salary accrues where services are rendered. And there's no liability on TDS even under treaty. That's what I'm saying. The domestic law, whatever say, but under treaty also, most of the treaty, every treaty will say that it is not taxable in India unless you are not there in US for 182 days or more. So if you are in India working entirely, it is not deductible. Bank account and insurance policies, if you are returning Indian, once you are back to India, you won't be allowed to take life insurance policy. You can continue with Mediclaim and other things, but life insurance policy you will not be allowed because IRDA restricts that. And the point which I'm trying to, why I've mentioned it here is that if you are coming back to India and you've got some product, which is investment product, which is unit linked product and insurance product, but within insurance product, you've got a good investment scheme, whereby you can internally within the insurance unit product, you can switch from debt to equity and without affecting taxation. You should opt that product before returning to India. Once you are back to India, you become resident in India, you won't be allowed to take life insurance policy. Emigrating Indian, if 6(4) stands for returning Indian, 6(5) stands for emigrating Indian. You can continue to own all Indian assets, whatever you are doing, need not close that thing. Of course, you should not be buying after you become non-resident. You should not be buying agriculture, plantation, or those kind of properties, which is restricted. So, if at all you wish to buy something is there, you should do it before you become non-resident. Section 6(4) and 6(5) refers to three classes of assets section: currency, securities, and immovable property. These are the three classes of assets. But in my view, it will also apply to other class of assets. It could be, your jewelry, it could be a vintage car, it could be yachts or whatever you have. I mean, 6(5) will allow, even 6(4) in my view, if you're returning back to India, will be allowed. Even crypto. So, for example, once you're back to India, you will not be allowed to send money for buying crypto because it is. The Reserve Bank still doesn't allow, and even AD will not allow it. It is legal. So they have lost. Reserve Bank lost the case in Supreme Court to say that crypto you cannot ban it. But the point is, if you are trying to keep a wallet overseas, I mean, unless you have got something in Coin DCX or WazirX, which is operating in India, and you are able to move, I mean, you are able to buy crypto with Indian currency, in my view, it is allowed. But if you are remitting overseas, it will not be allowed. So whatever assets you want to create, digital assets, something which is likely controversial, you should acquire before returning back to India. And once you can, asset is created over there, in my view, you can continue to own the asset. You can even play within that asset, sell crypto, buy crypto, provided there is no exposure, fresh exposure from India. Partnership firm, you can continue to be partner even after becoming non-resident. Only thing that, having left India, you continue to be partner, but don't try to pay interest to non-resident. Why I'm saying that, under FEMA, there's no concept of, current capital, fixed capital, or what is deductible under income tax percentage, it will be treated as a debt. So what we do generally under, our firm is that if you are continuing non-resident to be partner, don't pay interest to them. Because for RBI, it will be treated as a debt. So for old capital account, you can still pay interest. Whatever before you left India, I mean, you are having those balances, you can continue to pay interest. But in my view, try to avoid those kind of interest payment to non-resident partners. And on fresh capital, whatever you are getting in, do it from NRO account and strictly no interest on that. Demat account, you can continue, I mentioned here. PPF, you can continue for up to period of 15 years or 5 years, and then you have to close it. Yeah, now comes the capital and current, okay? So as I mentioned, this concept was absent under FARA. There was no concept of current and capital. Every foreign exchange requirement, every draw of foreign exchange, you will have to go to RBI. And then request RBI and RBI will grant you. As I mentioned, India became signatory in 1992 to WTO. We opened up our economy and we say that, India is now today open on current account. And that's why we are fully open on current account, subject to foreign trade policy, which every country will have. Now, today, US has put sanctions on China to say that, even the US is a liberal economy, open economy, there's a full currency is fully convertible. I mean, still they have put restrictions considering their economy or whatever geopolitical reasons they will. Similarly, foreign trade policy will play its own part to say that these items are prohibited, these are not allowed. But when it comes to pure current account, we are fully open. So today, if I want to import whatever is the amount, I'll be able to import. Okay, subject to foreign trade policy. So that is how the current and capital, and there's a definition of capital account. So what is capital account transaction? So capital account transaction means a transaction which alters assets or liabilities, including contingent liabilities outside India of person resident in India, or assets and liabilities in India of person resident outside India, and includes transaction referred to in 6.3. Now 6.3 is no more in place, but look at the first part. Whatever transaction which a resident takes place, which has an impact of changing assets and liabilities overseas. So whatever, for example, I remit money, okay, to buy shares in Microsoft under portfolio investment scheme or as a overseas portfolio investment, it becomes a capital account transaction because I have created asset overseas. Similarly, non-resident making investment in India, okay, it becomes investment. You are holding securities, you are holding immovable property, whatever you are holding, it becomes capital account transaction. So for non-resident, you changes in assets and liabilities in India. For resident, changes in assets and liabilities outside India will become capital account transaction. Now try to understand this with how FEMA has impact on it. While definition says that it's capital and current, and this has got very relevance in this. As I mentioned, if you are fully open on current account, if you can structure a transaction which says that it is not a capital account transaction, but it is a current account transaction, it will be generally permissible. If it is a transaction on capital account, there will be some reporting. At times there could be prohibition also. As I mentioned, non-resident, once you become NRI, you cannot acquire agricultural plantation or farmhouse in India, right? But if you're a resident, you can. So if you're non-resident, you cannot do. So for capital account transaction, there are restrictions and there are reportings. Current account transaction, there is reporting, as I mentioned, but it is subtly done through AD. You will not have any specific obligation, which is more severe in case of capital account transaction. So if you can structure a transaction which is in the form of current account, it will have very less compliances. Okay. For example, unincorporated joint ventures. For example, technological collaboration. Instead of financial collaboration, become a joint venture. If you can create a technological collaboration, say for example, you are taking a franchisee of McDonald's. Okay. So MACD, you're just taking a franchisee. Even though I am getting into business, there could be profit sharing, there could be revenue sharing, but still it is a current account. So this is where current and capital will have a lot of impact if you are structuring particular transaction. So gift of money. A father is gifting from India under liberalized remittance scheme certain money to son. Is it capital or current? It is a current account transaction because father has not created any asset overseas, right? He has reduced his assets in India, but in India, not overseas. Even son has, for son also it is a current account transaction because his assets have not been created in India. He has increased his bank balance in US, for example, and therefore it is a current account transaction. So therefore, being current account transaction, it is freely permissible, subject to, of course, liberalized remittance scheme, which is restriction, but it is quite substantial at $250,000. But the point is, this is how you will examine. Moment it is a current account transaction, by and large, it will be allowed. You will just fill up A2 form, certain declaration, and the country should be FATF compliant and other things. You'll be allowed to carry out. If you recently we have got the scam, probably you will find that under the freight and folly for, I mean, this kind of payments, 10,000 crores have been remitted from India. There has been firm which has created 98 or 100 entities in India. Recently we saw, and then based on 15 CSCB, we remitted money. So this is the misuse of the facility because it is a current account transaction, you can freely remit. But look at the more relaxation, more ease of doing business, but look at the way, this is done. So even the 15 CSCB, when you are issuing, you'll have to be extra careful because once the transaction or foreign exchange is getting into the hands of certain unwanted elements, it will be very, very difficult even for chartered accountant to plead because these kind of matters which will go directly to ED because it has impact on sovereignty of country, the defense, the security system of country, and therefore one will have to be careful. Yeah.
My question is if the son makes investment in capital asset from the funds remitted by his father.
So you now examine yourself. What is the status of son?
Non-risk,
Now, how why FEMA will apply?
the camouflage transaction.
No, but FEMA, why FEMA will apply? Why FEMA will apply? You have remitted money to son. Son is investing. What is the status of son? You examine. If you treat him as a resident under FEMA, there is a challenge. As I mentioned, student. If you make him non-resident, then have you displaced him as non-resident under FEMA by converting to NR or NRE? No. If you're not done, he is resident under FEMA. And then if you're making investment, then there's a slightly challenging because you're left on student and you are making gifting money to a resident, which is not allowed. Resident to resident foreign exchange gift is not allowed. Yeah.
There is an HUF.
HUF will take offline because it will be quite complicated and HUF because overseas country don't recognize HUF and that's why there's a challenge. So
So,
yeah.
if a resident makes a gift of security, like listed shares or unlisted shares, will it be covered under LRS or?
No. When I say remittance means remittance.
Okay, no, that is okay. Now suppose.
So gift of security is under approval route. If listed or unlisted, Indian resident giving to non-resident shares, be it listed or unlisted, it is under approval route and that too only $50,000.
Yeah, 50,000.
Right, yeah.
You have to take approval under.
Yeah, approval.
NDI, whatever.
Yeah. So NDA was approval required. Now the point is since he has raised the point and I've just tried to address. There have been few instances where authorized dealers have taken a view that if you are holding listed shares, okay, and if you are gifting to shares to non-resident, okay, and it continues to be non-repeatable investment because it will be non-repeatable. You are investing, so money cannot be repeated outside India upon sale. When you say non-repeatable means you have the demat account, which is non-repeatable account. Then few entities have allowed gift, which I am also surprised.
Okay, so yeah, that is what I'm coming to. That some people believe that father is transferring shares in demat account of child. And then next day child is selling security, I mean whatever shares transferred. And then up to 1 million, then he can take away.
Yeah.
From his NRO account.
Yeah, so you are trying to remit something more money instead of LRS, you are using this route.
Yeah.
Yeah. So,
But is it, I mean, what is the legitimacy of this?
so legitimacy is if you look at strictly by NDA rules, the rules doesn't distinguish between listed and unlisted. They don't distinguish, the rule doesn't distinguish between what are the shares which are to be gifted. And they say it is under approval route. As you rightly mentioned, 50,000.
You necessarily require RBI approval before.
Yeah,
getting
yeah,
into
yeah.
transaction.
But
Now my second question is that father is resident and he is. Is holding equity share, I mean, local business. Now, that he wants to transfer to,
so everything I said, listed, unlisted, both are under approval route.
okay,
Both are
but
under,
approval will be given.
of course, should be given. Yeah, it will take its own time. It will take its own time. But it will be, because if it is relative, falling under definition of 277, it should be.
Now, if we create like a joint shareholding in favor of NR.
So joint shareholding, is it becoming owner or not? I mean, if you just add the name as a second holder and if he is not contributing or keep him a nominee, that's not an issue.
Oh, thank you.
That's not, okay. So what are the implication on gift? So resident to non-resident security is under approval route, but as I mentioned, there are certain ADs which are taking a view that if it is a listed shares, it can be gifted without any approval, and they have undertaken the transitions, which, you know, probably there's no synchronization between law and the actual action taken. Of course, when AD takes a view, it is the view of RBI because he acts as an agent of RBI, but still, you know, there is some gray area. Gift of foreign security. Now there's a foreign security and there is a gift. So, you know, non-resident is gifting to resident. So it is permissible under FEMA, subject to now additional compliance under FCI, Foreign Contribution Regulation Act. If it is coming from NRI, it will not be, but if it's coming from OCI, you know, it will have its implication. Resident to resident, it is allowed to have a gift of foreign security. You can gift foreign security to resident, and resident to non-resident, again under approval route. When it comes to inheritance of foreign security, it is permissible. If you are inheriting foreign security from non-resident, it is allowed. Resident to non-resident also allowed. Surprisingly, resident to non-resident, FEMA is silent, you can say it is not under general permission, but in my view, you know, inheritance cannot be stopped. If you are bequeathing of your choice, even if it is not relative, you can't stop, of course. At the time of transferring and not transferring, but at the time of transmission, if I correctly use the term, but there could be some compliance, but you can't stop that. Now, gift of immovable property situated outside India. There's a property which is immovable, which is outside India. Non-resident is wanting to give to resident. Surprisingly, this is an inward gift, but it requires prior RBI approval. So immovable property, even if coming, you know, from non-resident to resident, you will have to take prior RBI approval. So we had a case where we had to literally go for compound. There was a case where there was an UK daughter, you know, which was the only child to their parents, and she left India. She settled in UK. She married to UK national, and she gifted a residential house in London to her father. So when they were on visiting UK, they entered into gift deed, they registered the property there, and everything took place. And thereafter, when they came back to India, this transition, since it requires approval, we suggested to go for compounding, because any asset held in contravention of Section 4, if you're holding asset, you know, not in contravention in accordance with FEMA, there could be ED implication later on if you do not, you know, comply at appropriate time. Therefore, we went for compounding. The interesting aspect which came out and which I want to draw your attention is that, you know, what the compounding authorities did that what is the value of property on the day when it was gifted. So they asked for valuation report. What is the valuation of property on the day when you are filing compounding? So there was a gap of 7.5 years or 1 year or so. So what is the valuation? And the difference between the valuation, if there is an appreciation, would have been entire amount would have been taken away by way of compounding fee. This is an undue gain, assuming that is undue gain. Now, the further add to the, you know, controversy to this or further complication to this and further loss to this is that everything is to be computed in Indian rupees. So yeah, everything. You can't say that there's a so everything. So if there's a assume for a while it was US property, you know, from 1.5 years back it was 76, 78, 79, today you're on 86. Luckily, in that case, Brexit had taken place and in fact pound has depreciated. And so this was the saving grace. And luckily the things didn't go. So there was some fixed fee of 2 lakh which was charged. But this is the way probably, we'll have to be careful when you are acquiring immovable property. I'm failing to understand the rationale for this thing, but it could be, there could be properties which is Benami property and you are trying to gift. A lot of foreign money is stashed overseas, and if you take a gift, somebody would gift you property. And if it is under automatic route, probably RBI wants to or restrict, they want to examine this. Who is the owner now? Second could be, property could have been, there could be property which has got a lot of dues on property tax, other issues in overseas, and therefore there could be larger foreign currency exposure. Because once you are owner of asset and you want to say, I want to now make property tax payment, it is a current account transaction. I'll have to go to bank and say that give me foreign exchange. You can't stop me. You can't stop me. So probably with this kind of approach, there is a possibility that there's under approved route. Now, there are few transactions which are otherwise in current account, but because of non-payment, because of passage of time, they become capital. And this is the change in nature of current account transaction because of import dues remaining outstanding for more than 3 years. As an auditor, if we keep on saying we are certifying, that the import dues are outstanding, and this becomes capital consumption. At times you will see that you sought an extension from, AD back to say that, I didn't pay, especially become holding subsidiary relationship or related party transaction where you will be extra careful. There have been compounding orders where this thing have been treated as deemed ECB. There's no concept of deeming provision under FEMA, but it is silently, this comes into play here to say that this is the import dues now are taking a character of borrowings. So this is the definition of current account: payments due in connection with foreign trade, payment due as interest on loan and income from investment, remittance of living expenses. So basically what we generally understand current account transaction is the current account. And current and capital, as I mentioned, it is quite significant because today we have got current account deficit as a India, right? And still we are sitting on comfortable foreign exchange reserves. Why? Because there's an inflow on capital. So we are sitting comfortably because there's huge money coming to India on FDI, on foreign portfolio, and there could be some income in the form of dividend, royalties, and other things. But capital account inflows are big, and therefore, even though we have got trade deficit, or I say current account deficit, not trade deficit, current account deficit, because our imports of gold. Now we are lesser import on mobile because we have got our own manufacturing in India, but maybe gold and oil. These are the things where probably, we find that we have got current account deficit, which is fulfilled quite in ahead of it in more than that by way of surplus or inward supply of foreign exchange on capital account, which is in the form of NRI FDs coming in, immovable property investment, and mainly FDI and foreign portfolio investment. So that is how it is there. Within current account, even though we are fully permissible, fully open, still there are some restrictions. So rightly so to say that, there are 3 schedules under current account. Schedule 1 is all prohibited transaction, like buying a lottery or, like, for example, gambling activity or certain things which are absolutely prohibited. You cannot, under LRS also you cannot do. Certain things are there which is even after becoming resident and you have got 6-4, you are a 6-4 person, you got asset overseas, you cannot enter into forward contract, you cannot enter into, speculative transaction. So that is some restrictions are there, which is mentioned in schedule 1. Collaboration for gambling activity. You cannot create a collaboration, financial collaboration for gambling activity. So these are the sometimes current account prohibition. This is schedule 2, which is current account prohibition in the sense that you will require approval of that particular ministry. So it could be cultural ministry or something else, which is the list which is given here. Then you've got schedule 3 under current account rules, which is mainly deals with LRS, and to say that, within LRS, so $250,000 scheme, you can do this up to 250, you can all do this transaction. So private visits to any country, gift or donation, going abroad for employment, emigration, expenses in connection with medical, travel for business, studies abroad. And these are the purposes which is listed here. But in addition to that, whatever is there, if it is under current account nature, you'll be allowed to do that within LRS if you are individual. item which are bold, 1, 4, 7, and 8, if there is a requirement to remit more money, RBI on a case-to-case basis will allow. For example, medical expenses in connection with medical treatment. There's a need and your expenditure is more than 250, you'll be allowed. Okay. For person other than individuals, this is given. I mean, again, if it is current account, as I mentioned, all the transactions subject to foreign trade policies are open. But this is particularly donations exceeding 1% of the foreign exchange earning or commission per transaction to agent abroad for sale of residential flat or commercial plots in India, exceeding so and so limit. So this is where, there's an agent sitting overseas and you are selling property in India. He's marketing for your behalf for sale of properties in India and what commission you can pay. So I was surprised to note that probably in 2007-8, when probably entire Asia was in demand for property, especially UAE was great demand. People used to buy properties, India also, there was a channel in FM channel in UK which used to market Indian properties. So, there were some announcements going on the FM channel for marketing properties in India. It could be highly concentrated NRI, you say, for example, Punjab or some areas where probably they were marketing in UK and they will invest their back properties in India, and for that we want to pay commission. When it comes to consultancy fees, remittance exceeding USD 10 million per project. So if you want to make, it's a current account transaction, you want to make consultancy fee, for example, this bullet train, which is, an Indian company wants to make payment to Japanese or whichever overseas company. And then the limit is 10 million per project. So it is QA project, not QA company. And if you exceed 10 million, it will lead to compounding. So per project, you may pay to more than one consultant, but within the project, you have to be within 10 million. Infrastructure structure defined because the consultancy 10 million limit stands for infra. Now comes what do you mean by current account transaction? This is a typical case to say that every amount which is in the nature of capital, you look like capital, but it may not be capital. In the sense that, for example, there is a non-resident Indian or say foreign national. He has been employed by an Indian company and he comes to India and he hires a accommodation, he hires a residential flat on legal access basis and he places a deposit with Indian owner. Now, this placement of deposit, is it current or capital? Because if you say this deposit is payable, in a way, if you say that, he has created asset in India, non-resident, and mind well, he may not be, because if it's for temporary period and his intention is not to stay in India, it could be non-resident, okay? And maybe so. So whether it becomes a capital account transaction or current account transaction, so the underlying principle is that if there's a consideration involved, and in lieu of that consideration, if there's a deposit given which may be repayable, it will be current account transaction. So the circular is there of 15 APDR 59 of 2016, where it was in connection with placement of deposit with an Indian company, where certain directorship, there's a law, articles may require that you will place certain deposit to qualify as director. And RBI clarified that, such type of deposits, if it is placed with company, it will be regarded as a current account transaction. The analogy which we may draw is that, if there's a consideration involved, which is not purely financial transaction per se, it would be in the nature of current account. Current to capital, we have already seen there is one possibility of converting current account to capital account is that there's a funds payable to your non-resident. Say, for example, foreign company has set up a subsidiary in India and they have incurred some expenditure foreign on behalf of company, and these funds are now payable to non-resident, to the parent company. You can convert that funds payable to equity capital, and that is allowed under FEMA, under automatic rule, subject to valuation report and other things. But those initially current account can legitimately convert it to capital account by issuing shares. Of course, under Companies Act and all that, you'll have to examine, and you will have to be very, very careful to say that, whenever there's an inflow of foreign exchange into India, you should always see that there is a bank realization certificate or whatever evidence, available with company to say that foreign exchange has been realized in the country. Now we'll touch upon liberalized remittance scheme. So it is a slight step towards capital account convertibility. What is capital account convertibility? Basically, I am trying to say that I am converting my capital, my Indian capital or a rupee capital into foreign exchange asset. So capital account convertibility, basically it was attempted twice. In Tarapur committee was appointed in early 2000 and later on even 2007, and then India should now move towards capital account convertibility. As we say, we are almost convertible on current account. When I say what do you mean by current account convertibility, I can convert my rupee into foreign currency for import of goods, import of service. Almost we are open, but not so on capital account. Okay, only $250,000 is allowed. So that is capital account. Now, what do you mean by capital account? I'm not going to hold generally capital overseas. If I remit money overseas, there will be some purpose. I'll be investing. I'll be investing as a startup venture. I'll be investing as a legitimate business. I'll be doing overseas direct investment. So these are I may buy immovable property under LRS. So basically, I'm converting my Indian capital, Indian wealth into foreign currency wealth. And RBI permitted this because they wanted Indians to go overseas and try to create asset overseas for productive purposes, for genuine purposes. As I mentioned, we are sitting on 600 billion or whatever amount of foreign exchange reserve. Now, what RBI will do with that? This is a question. It's a big worry for RBI. They keep on receiving foreign exchange. They will have to deploy this money where? They can't sit idle on it. Therefore, they have no other choice but to go into US Treasury bond, Euro Treasury bond. If not, they will buy gold. They will buy gold. And this is so dynamic. You have to judge. This is. Subject is really interesting also and scary also. Tomorrow, if US economic collapses, something happens, probably it will have a ripple effect, and the biggest impact will be on China, and probably nobody will be spared. So we luckily in India, we don't have to educate our Indian population to say that you buy gold. But in China, the China Doordarshan, in the sense the Chinese national television, they used to telecast an ad, buy gold. They used to tell their resident to buy gold, because we are used to buying gold. We've got fancy for gold since centuries and centuries, right? Any poorest people will have some gold, Probably we will be individually will be sitting on huge amount of gold resource of overall gold in the universe that we will be having. The moment central government or central bank of any country starts buying gold, it will have inflationary effect on gold, and therefore you will find that suddenly gold went up from today's with the price because every country wanted to keep in gold. Because there's no sanctity, there is no surety of how US is going to perform, and therefore, as a checks and balance, as a prudent mechanism, you'll have to put your eggs not in one basket but then spread it over. So therefore, the capital account convertibility becomes important, and therefore judicial use, a proper or prudent use of foreign exchange to create wealth overseas and spread our risk also. With this intention, the liberalized remittance scheme has been introduced. There are some fallbacks of it. People have started buying property which was excess of $250,000. They created a company, and because you cannot buy, so they created a company vehicle, and the company bought the property, which is not. So under overseas direct investment also, they say that you will go overseas, but do bona fide business. They use the word bona fide business. Business which is really leading to employment, leading to generation of earnings, and it's a productive purpose. You may suffer loss, that's okay. You may write off your investment, but not create a vehicle, not create a entity overseas just for the purpose of holding immovable property and earning rental on it. They are not even allowed to borrow or pledge the property and take further exposure on that property. You're not allowed that whatever is my rental, I'll be able to pay my EMI out of that rental. You will not be allowed. So in short, the LRS is meant for Indian resident to remit money overseas and use it for whatever legitimate purposes. If you're not able to utilize those money within 180 days, bring it back to India. This is the growth. Initially started in 2004 with $25,000, and in between, in September 2007, it was 2 lakh. It was brought to 75,000, then 125, and then 250. This was a time in 2013 when dollar went from 54 to 69 in a span of 15-20 days. So RBI had to intervene. We are curtailing now, of course. So that is where. LRS has been revised, and there are certain challenges and certain restrictions which have been introduced from August 22. They say that it is available to all residents, including minors. Clubbing is not permitted by other family members for capital account transactions such as opening a bank account or investment if they are not the co-owners or co-partners of the overseas bank account or investment. So if you are opening a joint account overseas, husband and wife remitting money, then you both should contribute. Okay, otherwise keep one of the spouse as a nominee. Hold account in one name and keep other spouse as a nominee. Because joint is not permitted unless you are co-owner or you are contributor. For even for securities investment or even for bank account. But it is not so for immovable property, surprisingly. So if he says only investment, and if you look at the direction properly, LRS, Master Direction LRS, they say remittance for purchase of property shall be in accordance with provision of capital account transaction, which is under overseas investment rules they've given. But immovable property overseas may not be held in joint account, even though contribution is by family members. So it does facilitate certain transition where, investment based visa program or residency program, where immovable property investment can be made, even though contribution is taking place from family members, but property is owned by only one person. Resident cannot give to another resident in foreign currency. Okay, so resident to resident foreign currency is not allowed. Today, I can't give in LRS, both the father and son are resident. I can't give gift. Banks should not extend any credit facilities for this. All other transactions which are otherwise not permissible under FEMA and those in the nature of margin or margin call are not allowed. Remittance under scheme can be used for purchase of object of art or such subject to provisions of FTP. Investors who has remitted funds under LRS can reinvest the income earned on investment. The resident is not required to repay the other funds or income generated out of investment. Subject to now changes to say that if income is whatever investment or realization is there, I have to use it within 180 days. If I'm not utilizing within 180 days, I'll repatriate back to India. And they use the 4 terms: the received, realized, unspent, and unused foreign exchange, unless reinvested, shall be repatriated back. So what do you mean by received? In my view, it represents income on past investments, which is probably dividend or interest or whatever. Realized is sale proceeds. So if I've got shares of say Microsoft and I dispose of the shares, which is realized. I have to invest within 180 days, if not bring it back. Unspent would be both capital and current account, whatever unspent remains or unused, which are, probably I've remitted the funds for making investment in property. Okay. And then due to some litigation or not proper, when I do the KYC or I realize that property is not worth buying or the risk involved and it is unused, then I have to bring back. You can open a bank account to facilitate the transaction that is allowed. Foreign currency account may be used for putting through all the transactions. You can have foreign currency bank account to undertake those transactions. And scheme is not available to capital account transactions to the countries which are identified by FATF to be non-cooperative. So there are certain countries, I think FATF does come out with a list, and there are certain countries which are not on FATF approved list. You will not be undertaking those transactions with those countries. Then this is TCS, which we will skip. Permissible capital account transaction, as I mentioned, opening a foreign currency bank account, acquisition of immovable property abroad, overseas direct investment, overseas portfolio investment, and extending loans, including loans in rupees. So this is where the controversy is. So far as overseas investment, which is ODI is concerned, or portfolio investment is concerned, is fine. Immovable property is fine, but loan can be given only to NRI in the NRO account. I am a resident Indian. And relative is defined as per 277. So I cannot, even though language uses that, extending loans, including loans in rupees. So meaning can be taken that, I can non-resident Indian, for example, or OCI can borrow from relative, which is defined under 277. But practically it has been seen that, it is not allowed because the notification dealing with lending by Indian resident to non-resident, they prohibit that. And here also only rupee loan is allowed, that is to NR account, and you should be relative as per Companies Act. Now, the relative as per Companies Act puts some restrictions. So grandfather and grandchild is not covered. Unlike 56 to 10, where definition is quite wide, 277 is a bit restrictive. So if recently we had a case where grandfather gifted to a grandchild and grandchild was NRI and they wanted to repatriate under $1 million scheme and it was not allowed. Because you're not qualifying to be relative under 277 for LRS. And $1 million also they restricted. Because gift to NRI in NRO account in India also is subject to LRS limit, even though I'm not remitting overseas. This is a rupee transaction taking place in India, but still it is kept up to $250,000, and then there was challenge in repatriating. Loans conditions are there, which is generally, yeah. So this is where probably I'm completing with current capital LRS part. And now we can look at the disclosure of foreign assets. Right, I have. Can you change the slide? Yeah, if it is registered, it should be regulated. It should be regulated in the host country. Say, for example, if it is US by SEC. Okay. Unregulated now. So there are some countries where fund manager is regulated, not fund. Singapore is such country where fund managers are regulated. So wherever there is a situation where fund manager is regulated to disclose the fact to AD, probably they will allow. They have not still put it, but AIF will be allowed. So it is not coming out of rules, overseas investment rules. If you see, they use the word listed securities, and therefore you find you are actually blocked there. You don't, if it is not listed, it may not be listed. But if you go to the regulation or overseas, not regulation, overseas investment directions, there they have said this, it should be regulated. Those will be current account transaction. If it is a fees payable based on investment, make a disclosure. This is the term sheet. I'll be paying so fees. Make a disclosure to AD. It will be current account transaction. Should not be issue.
So can an Indian company buy Bitcoin?
I said no. I mean, Bitcoin. See, if you are remitting money overseas, okay. As I mentioned, if you are doing it as a rupee transaction with exchange in India, with full KYC, and you do the KYC of that exchange, right? So if there's no foreign currency exposure and wallet is in India, it is allowed. Subject to again your articles and other things and look at it. But remitting money overseas as a current account transaction, no. There's a one will not be, it will not be allowed. If you write A2 form and says I want to buy crypto, it will not be allowed. Now we look at black money or undisclosed foreign income and assets. So firstly, there should be asset which is located outside India, right? It should be asset which is located outside India. And then there are, what is this important terms which we will look at: applicability and procedure, assessment under black money, disclosure in ITR, and reference to judicial pronouncement and importance of documentation. So there's an asset including financial interest in any entity which is outside India, and again it applies to resident. And resident offers no explanation, or explanation offered by him is unsatisfactory. You are in the rigors of Black Money Act. Okay, there's an asset overseas. The person owning is resident Indian.
Under income tax.
Under income tax. This is now under all black money. This is under income tax act. So person owning is a resident, and they say resident at the time of acquisition. You may be non-resident, you may be urban and or in current date, but when you acquired the asset, when the asset was acquired, you were resident. Okay. And you offer no explanation, or certain explanation is not offered. So the primary thing is under black money is that source of investment is not satisfactorily explained. The first example which I gave, about an architect acquiring immovable property overseas in exchange of fees. Now, if this fee was offered for tax in India and this asset was disclosed, probably it is a contravention under FEMA, but may not be under black money. Because I have fully paid tax on this Indian income, I mean the income based on currency translation, and I have disclosed the income tax return in Schedule F also. So what is important is source. Satisfactory explanation is the source of investment. If I am resident and owning an asset overseas, what is the source of investment? They use the term meaning of ownership to mean that either you are a legal owner, you are a beneficiary owner, or beneficiary. So legal owner is quite clear. The property also stands in my name, and I'm legally through documentation, through property or public records, I'm the owner. Okay. Or you are a beneficial owner. And beneficial owner is, they relied upon the explanation 4 to section 139 of Income Tax Act. So we are looking at black money, but black money relies on this definition. To say that an individual who has provided directly or indirectly consideration for the asset for the immediate or future benefit, direct or indirect of himself or any other person. So I am a beneficial owner, kind of a benami. One aspect is that consideration has been directly or indirectly given. And I am owning that asset for my use or for immediate use or for my relatives or my whatever, somebody else also, but I am a beneficial owner. Okay. Legal owner, and third is beneficiary. So I, like a family trust, my name is there as a beneficiary. So I am not an owner, I am not a beneficial owner. There's no consideration as which has moved from my account or on my behalf, or I have not used third party conduit, but I'm merely a beneficiary. So again, this is explanation 5 to 139. An individual who derives benefit from the asset during the previous year and the consideration for such asset has been provided by any person other than such beneficiary. These three circumstances, this is the ownership. Ownership is legal and beneficial, but even beneficiary, you will have to disclosure requirement is there, and therefore I have covered it as a fundamental thing, what you should bear in mind. Nominee will not get covered here because nominee is not beneficiary. Okay. So nominee, if you are merely a nominee, in my view, there is no disclosure requirement even under Schedule F. Right? An individual who has provided, this is where the beneficial ownership, which we already seen, directly or indirectly consideration for the asset for the immediate or future benefit. Now, to establish beneficial ownership, resident should have nexus to the source of income. As I'm harping again and again, you should have nexus to the source of investment. This was a case which is about 128 taxmen. The father's name was just included as a convenience, second holder. You are raising about second holder. And this father failed to disclose this in income tax return. And information was shared by under automatic exchange of information, AEOI, that Mr. Jatinder Mehra, you are the owning bank account. And therefore, you not disclose this. These are the number of years. Per year penalty 10 lakhs, please pay. Right?
Suppose property.
Wait. So the point is, then matter went to tribunal. He said that there's no contribution from man. And this beneficial owner is, I'm not beneficial owner. My son has kept my name just for convenience, so that in case of any unfortunate event, the legal hassle are reduced, and therefore penalty was dropped. But there have been cases, I have not reported here, there have been cases where assessee has offered income on those assets in income tax return, but failed to disclose in FA, penalty has been upheld. Penalty has been upheld. So there are views on both the sides. It becomes you have to be very careful when you have got LRS assets and returning Indians. You have to be very careful. So what do you mean by overseas assets? And there are certain instances where I'll come or touch upon that. The point is, yeah.
Foreign assets are held by jointly by husband and wife. Husband has earned income foreign and invested in the security. While when he came to India, at that time, husband has already declared in his personal return, but wife is not declared.
You declare now.
No, whether is it mandatory to declare it?
Mandatory to declare. Mandatory to declare.
But suppose if I give the affidavit that income is earned.
So matter is mandatory because this is the litigation. Tribunal upheld, there's no need to disclose. But there's a see, you are owning an asset as a joint holder or this holder. This is not mentioned here. If you look at the definition also, legal owner, you are legal owner.
But in return, there is no column is there.
You are legal owner or not? Tell me jointly.
Jointly.
You are legal owner. Mind, see, you go by language. Let's not debate. I'm devil's advocate now. I'm sitting on tax office. How will I know at first instance that you are not a genuine owner or legal owner? For me, it is legal ownership is there. Mandatory requirement is to disclose.
But only for the convenience purpose, my name.
So that's what I'm saying. No, that's what I'm saying. You take to litigation. No, that's what I'm saying. It will matter. Can go to litigation. See, at first instance, examine now with AI things coming in, the system-driven verification is going on. How are we going to examine whether it is a beneficial owner or affidavit and all that? Is it possible? No. Unless now, if you see the notices which are coming from investigation cell,
Yes.
right? The number of notices will reduce now. They have now introduced a system whereby they're able to map the transaction, returning Indians, such type of cases which you are mentioning. And probably in the days to come, you will find that this number of notice will reduce. Today, if you see this 70% of the notices are there, where returning Indians are there, they've got bank account and which are already disclosed. But there are certain technical issues. I tell you how. We had a case where foreign accounts. Now, what do you mean by foreign accounts? There were a case where FD were maintained 8 FDs of $1 lakh. Okay, we reported only one. The system captured 8 accounts and they say you will not disclose 7 accounts. So matter is going on with investigation. So these are the challenges where software or system or AI will not pick up these things. They are improvising, but it will take time. In your case also, are you not a legal owner as a second holder? You are legal owner. So
Yes.
therefore it is requirement, you disclose.
But yeah, in the investigation department, I have given the indemnity that,
Fine, so say they will sit on it. It is investigation. Now this matter can get reported to assessing officer. The notice can come and then you explain. Either it will go under normal tax return or it can go under BMA. You explain. You will have a very good chance to say that there is no contribution and you will have to have all documentary evidence. See the challenge, I tell you why it is. Nobody would have kept transaction or records for 15-20 years ago,
correct.
right? How will you establish that no contribution was made? Now burden is on you to establish that my wife has not contributed anything, entire contribution from his salary, income and all that. So if you create the document, you have got all these things, you will be able to sail through easily. But the challenge comes because many a times these are old transaction where documentation is a weak.
But suppose if the.
We will take now offline because otherwise we will not complete here. Yeah. So the point is, you know that, see, disclose करने में जाता क्या है आपका मैं बताऊं. Now you have to be very careful when you are looking at foreign currency assets that you know, since topic is there and I just touch upon the last part. Yeah. These are the instances which generally get skipped. One is social security account. We got a notice about pensions, social security, which is an SS monthly pension which government gives, and this account was not disclosed. Now we find that this account is social security is a pension which is coming, but there is a separate account, and this account was not disclosed. You got a notice to say that we have identified. Now automatic exchange of information is so robust across globe, and this tax heaven, BVI or Jersey or this island, one email goes from Indian tax office, they sit on the, they rise from the chair and submit everything. You don't have any stand to argue that I was not aware of the things. Bhai, passport आपने ही दिया आपका KYC पूरा उधर है, your signature is there, everything is there. How, what are you saying? There's no possibility now to skip those things. So therefore, I'm trying to say that one is social security account, another is 401k account of US, because most of the NRIs are of US, they come back. 401k is nothing but your provident fund account, something like 3 years, right? This, even though you disclose everything, 401k remains. And when we ask 401k, hai, mere paas 401k, and there's a substantial money because you've got lifelong savings standing there. So disclose that. Beneficial interest in trust, dormant bank accounts. No, you have to really dig out your memory. Go back past, be nostalgic, go down the memory lane. We got a case where he said, Bahrain account to main to bhul hi gaya. The tax department has got information. You may not be aware, but they have got information. So, or if there are accounts, close it. Tell them to close it. But this has become mandatory. And bank FD with negligible balances. You may find that it is negligible, but you'll have to disclose. There is no escaping. And see, I tell you, I come across a case, we find that, it is injustice to us. We as a professional, we find probably we are sitting here and we are all white collar professional and we are not seeing what is going on. But I have come across few cases where people are, just recently, 10,000 crores have been siphoned off from Indian economy, right? Now, if they try to give you a relaxation, it will not work for them. They will have to come strictly with this thing. And entire world does that. US is the first country. You have to not only disclose in income tax return, there is FBAR separate form. Obama came, they introduced this voluntary disclosure scheme about disclosure of foreign assets by US person in 2008. The scheme, voluntary disclosure scheme went on for 4 years. First year, no interest, no penalty, then 25% interest penalty likewise. And every country now wants their citizen, their resident taxpayer to disclose all their foreign income. So let's not, crib about it, disclose it and be peace. Because today, the kind of information which they have got through your mobile is enormous. You and me cannot imagine. And now with more and more advancement technology and AI playing quite vital role, probably they will have much more analytical skills and analytical knowledge. If not, I'm saying information knowledge, because they will develop that, tools to come out with what can happen with this kind of taxpayer. Yeah. So we have looked at beneficial owner, legal owner. Now we come to basic conditions. So you should be resident and ordinary resident. Resident but not ordinary, you must pay. You have to be resident under 6(6), you have to be resident pure. Here comes a play, you might look at treaty and say that, under tiebreaker treaty, a tiebreaker test, I am not a resident. If that is possible, genuinely, in the case of returning Indians or somewhere, you may try that. I'm not going into detail of it, but for the time being, if you're a resident, yes, assessee was resident at the time of acquisition. Mind well, at the time of acquisition. Disclosure is at the time you are resident, but Black Money Act triggers if you are resident at the time of acquisition. If your acquisition at the time of acquisition you are resident, if it is yes, then source of investment. Prove the source of investment. It is through LRS, it is through ESOP, it is through whatever means. If it is a gift, prove the gift. Whatever is the source, either it is a currency gift or securities gift, whatever is there, prove it. Okay. And therefore the relevance of documentation. If you are remitting money under LRS and if you disclose that this money is spent for acquisition of property or so and so, so and so, so and so, it will help you a lot. It will help you a lot and maintain that. If it is explainable, as I mentioned, no issue. If it is non-explainable or explanation is not satisfactory, then it qualifies as undisclosed foreign asset. Okay. If there is no foreign asset, BMA will not apply. Or if you are non-resident or R but NR at the time of acquisition, then it is not applicable. Okay. And circular number 13, which was issued at the time of voluntary disclosure of black money and foreign income, there is a question number 23 and 32 also says that it will have no implication. Procedure. Generally, what happens? So they will be sitting on information. You will have intimation, investigation notice from 131(1)A and you supply the information, right? Now, probably as on date, you will find that there is no conclusion on that notice. Most of you will find that, they are just collecting information because probably they have got so much work. Some 15,000-20,000 notice I'm told are issued by Bombay office only, Air India, right? And they are not able to decide. So you keep on supplying information. In case of very severe or certain large scale cases, probably item will be referred to tax officer, assessing officer, and they will issue notice under section 10 of Black Money Act. But otherwise, by and large, you have been giving information and this is the status. The conclusion of investigation can lead to notice under section 10 of Black Money Act, and assessment will lead to a tax of 30% tax plus interest under section 40 from the date when the information is got, the year in which they got the office and they know information. So there's no separate return under Black Money. The source of information is your own return. Your own return is the starting point because you are not disclosed at foreign exchange asset. They got the information that this information return has been filed, but your asset is not disclosed, or you have not filed the return at all. Right? The two cases. So starting point is your return, which has got no disclosure, which should have been done. Information they've got. So there is a assessment, section 10 notice, which can lead to interest and penalty under 41, which is 3 times the tax. So you end up paying 120% tax. Then there is disclosure penalty, which is 10 lakhs per annum for non-disclosure of asset beginning from the assessment year 2016-17. Okay. And remedy is that either you revise the return whatever is possible within the time limit. You do a 139.45 whatever is possible. And another issue is, whether, and another is prosecution. So in addition to 120% tax, there is also provision for prosecution. No penalty in case value of movable asset is up to 20 lakhs. So now from October 24, they have increased the limit of 5 lakhs and there are 2 changes. One was up to the 5 lakhs asset, which was in the nature of foreign bank accounts prior to October 24. If there's a bank accounts combined total of which is convertible into INR based on SBI TT buying rate, if it was less than 5 lakhs, there was no penalty of 10 lakhs. Okay. The amendment now is that the limit from 5 lakh has been enhanced to 20 lakhs. In addition to that, 20 lakhs comprises not only of bank account but all movable assets. It could be securities, it could be crypto or whatever, okay? So those things up to 20 lakhs, there will be no penalty of 10 lakhs. Of course, disclosure, if there's, if you have got no satisfactory explanation, there could be section 10 notice and 41 tax could trigger. 20 lakhs is only for disclosure. That doesn't mean that you are spared from tax rigors of section 10 of Black Money Act if explanation is not satisfactory. There is no time limit prescribed under section 10 for issue of notice. So moment information is received by them, it can lead to notice. It may so happen that that asset has been sold, that money has been spent on foreign tour travels, you have disposed of the money, you are left with nothing. Still, if the information is there, it can lead to Black Money Act implication. Because information is now in the possession of tax officer and procedure will start from that. Moment that information is there, this investigation cell will transfer it to tax officer and assessment will take place then. So there's no time limit given, but this case law, Harvansh Chawla, there, there's a reference to say that, within 30 days from the information which is shared, in my view, by investigation cell to the relevant tax officer, you should have issued notice.
But still notice is not issued.
Exactly, that's what I'm saying. They are sitting on 2 years, 3 years. Exactly. I'm
I
saying.
cannot revise the return, I cannot file the return also. That's-
So you may try to write to CBDT on 119, try to say that, ask for a plea, that I want to revise return, this is genuine error, and I want to revise my wife's return. I mean, that's taxpayer's return, try to do that.
CPD.
Yeah, 119, try that. But now at least start disclosing now.
But now I can disclose in this current.
It is better to disclose. See, 10 lakh is a big exposure. Once it goes, then it is, you demonstrate your intention that, I'm trying to comply. And it is a genuine error. It was a second owner, no contribution from this. It is fully disclosed in husband's account. So chances of penalty getting, because they use the word me.
But in the return, there is no column as such, whether you are voting an individual account or joint account.
So fine, they will amend later on. But as on date, they have not failed to envisage. There could be joint holdings, there could be, co-holding. But you are a legal owner. Should have written, and let's not argue on those things. I mean, you cannot envisage it. They will also learn from experience. As I'm saying, you will find that this frequency and the number of notices will reduce. They are improvising within their system and it will get reduced. But as on date, you are a legal owner, being a joint holder, disclose. Section 10 of the Act states that assessing office on receipt of information from a tax authority or any other law request documents. So this is a procedure. They will ask for documentation, evaluate gathered evidence, make best judgment assessment or so and so. And section 4.3 of the Black Money Act explicitly states that the income included as undisclosed foreign income shall not form part of total income. Yeah. Total income. So whatever is disclosed under black money will not form part of total income under normal listing, and it will not be even allowed to, set off losses and other things. If notice is not issued under section 10 of Income Tax Act, a normal assessment, even on the credits, this typically happens in case of NRIs making investment in bank FDs and all that things where 68, 69 can be there. And you will have to again produce your all the inward remittances. And there are, in my presentation, I was given case laws where based on proper disclosure of remittance from overseas sufficient documentary evidence and tax tax filings of those countries, the 68, 69s have been dropped. Okay. NRI becoming resident, again, this is on this thing. Disclosure requirement, you all know it is more of a tabular format. I'm not going into detail. As I mentioned, nominee should not be disclosed. Only thing I just touch upon this aspect. Yeah. So see, there are countries where there is no need to file tax return. If you are non-resident of a country where you are supposed to file tax return, you will have all the evidence to say that my source of income is overseas, and this is the investment made from those foreign income, which is also 6. But say for example, country like UAE, where there's no need to file tax return. In that case, especially you should ask your client to prepare the balance sheet or net worth statement every year or every alternate year and get it certified by CPA over there to say that this is my income, this is my net worth, this is my assets and liability position. And when you're remitting funds from abroad, proper documentation should be there. Bank realization certificate for investment has been made. You should keep that. Secondly, for NRIs, continue to file tax return in India. Even if they've got below taxable income, better to file continue, because then later on tax department will not be able to allege that money has been moved from India to overseas, because whatever income was there, I have disclosed in my tax return in India as NRI, and there's no more income that I have. So filing tax return by NRI, even if they've got very limited income in India, it is always advisable. Yeah, okay, thank you so much. I'll shut.
Thank you, CM Manusha. The interaction session is very good. And members, please note that he has explained the need and FEMA relative relevance, and also explained in detail the structure of FEMA, that is whether it's a FEMA Act, notifications, rules, the directions, circulars, etc. We have learned a lot of issues on substantial provisions and sections of FEMA. Residential stresses has been discussed in detail. And he has covered various transactions under FEMA Act, and he has also covered the convertibility of capital account under LRS scheme. The last one under black money transactions, also under Income Tax Act, he has covered it. And with this, I request all of you to join me with a lot of. Please note that we have a separate folder for Jain.